Hi, this is Timothy Schutte with Exit Realty and Associates. Welcome back to my video blog. You know, a few weeks ago, we're talking about how the interest rates would be coming down with the 10-year treasuries because the labor market statistics were getting proven to be wrong, or there's something different with that. And the jobs numbers got reduced by a little over 900,000 for the previous year. And that Trump was trying to replace a few Fed governors to get those rates lower. Well, September 17th happens. They did lower the 10-year treasury for the first time in a year. I think it happened in September of last year. They dropped it a quarter point as well. They've been holding steady this year because they were really looking at tariffs and job numbers and saying job numbers looked good. Well, they haven't looked as good. So with that quarter point drop, that's pretty important, and they signaled there could be two more this year. One of the Fed governors actually voted for a 50 basis points drop, or 0.5% drop, which I personally would have been in favor of, because I do think that our real estate market could use that today. With that said, the 10-year treasury is not what dictates and sets the mortgage interest rates. Mortgage interest rates for the previous 2 to 3 weeks have been coming down because I think they did see and baked into the fact that we expected the Fed to reduce that rate. Now, what happens when the Fed Treasury rates changes by that 0.25%? If you're on a commercial mortgage, that affects it, I think, a little bit more directly. But when you're 15, 30-year fixed rate mortgages that are on secondary mortgage market, with the treasury yield dropping, what happens is when the yield drops, generally speaking, you see mortgage rates drop as well. When the yield goes up, you generally see mortgage rates go up. And you could go into deeper details about inverse yield curves and stuff like that. And we've had that happen a few times the last few years. But what that really means, though, is with it going down, that correlation between the mortgage and the yield on the treasury does block more money from treasuries into the mortgage market, because it's also a very safe financial tool. And that extra money makes mortgages interest rates go down. We're pretty excited to see what happens the next few months with the Fed, hoping that they do continue to lower that rate. That creates a lot of more opportunity in the real estate market for people and really helps buyers when the mortgage rates drop. In quick closing, what does this mean? We got lower interest rates on the 10-year treasury. We have a lower yield, which makes mortgages more attractive for an investor. And for our buyers and sellers, I think that's going to mean we're going to see more activity from buyers once they realize that their purchasing power will be going up. If you have any questions, please feel free to reach out. Would love to chat with you. This is Timothy Schutte with Exit Realty and Associates.